Well, good morning, everyone. Thank you for joining our webinar. My name's Ben Seeger-Scott, Chief Investment Officer here at Forvis Mazars. I'm joined, as always, by George Ligarius, our Chief Economist. So thank you for joining. This is our regular economics and investment webinar brought to you by our Economics Hub. We will be going through the usual. So if we can go to the next slide, please. Here is the running order. We'll start with economics. George will give you an overview of everything that is happening, or some of the things that are happening in the world. And then I will dive into markets and then what we're doing in portfolios before we wrap up and have the Q&A. So I anticipate the presentational element will run for 20 to 30 minutes. There should be a Q&A, a question box at the bottom of your screen. So if you do have any questions, please put them in there and we'll come to them at the end. Thank you also to everyone that submitted your questions in advance. So we will get through as many of those questions as we can. If we don't have time in the main webinar, assuming that you provide us with your email address, we will commit to responding to you afterwards via email as well. But with that, there is a huge amount going on in the world, still events in the Middle East, things happening with the US government, with trade policies, and we're going through a corporate earnings season at the moment. So there's lots that we are thinking and seeing. We'll touch on a few of them now. If there are any areas you're interested in that we don't touch on, again, that's an opportunity for the Q&A. But with that, I'll hand over to George to take us through the economic section. George?
Thank you. Thank you very much, Ben, and welcome to our bi-monthly webinar. Now, a few months ago, in fact, a year ago, I had very publicly exclaimed that if I hear the word Hormuz one more time, I'll quit my job. So it seems that fate is not without a sense of irony, because Hormuz is probably all that we've been hearing for the past 3 months. Now, the closure of the Strait of Hormuz is not just a geopolitical problem. It's not just an economic problem. It is predominantly an inflation problem. Okay, energy inflation, which in and by itself could be transitory, but if it remains for much longer, then there is a risk that it could go from supply inflation of one product to supply inflation of many products, and then it can become demand inflation as people go to their employer and they say, okay, last year inflation was 5%. If you don't pay me at least as much, then I'll consider that you're reducing my salary. And especially in the US, but also in the UK, where the labor market is fairly open, it's easier to have those discussions. Less so in Europe. That's why you see inflation a little bit more contained there. Okay, now we're nowhere near that point yet. Inflation has not become entrenched, but there is a ticking clock. Okay, and that ticking clock has risen very high above Hormuz. We are already almost 3 months into this. We have eaten into most of the strategic reserves. America knows this, China knows this, Iran knows this. So this is a very high stakes game of chicken. Now, next slide, please. What is our framework? We go back to our framework as we always do in these situations: debt, disruption, and deregulation. Debt is the main engine of growth. We have a lot of debt. Debt is 310% of global GDP. More important in two major economies, the United States and the UK, for different reasons. Interest expenses is very high. In the US, because just debt is very high, it's been rising very quickly. It's now more than 4% of GDP. And in the UK, the problem is that 25% of bond issuance is inflation linked. So 25% of the debt responds immediately to higher inflation, limiting fiscal space. So there is a lot of debt out there limiting fiscal space, thus making governments unpopular, and that breeds political disruption. In the UK, we're no strangers to such things. And of course, you still have the additional disruptive element of AI, which we're not going to touch upon today. The third part is deregulation, as we try to, invent growth in a world where we cannot borrow anymore and we cannot have children faster, and the productivity gains from the AI revolution are not yet very visible. We try to deregulate as fast as we can to allow money to flow. Now, this is the framework, and in a world with so much debt, inflation is both a blessing and a curse. It is a blessing in the sense that you can inflate some of the debt away. It is a curse because if you hold bonds in your portfolio, or if you haven't borrowed yet and you want to borrow, you're going to do so at much higher rates. And if you hold bonds in your portfolio, then that value has gone down. Okay, next slide, please. So let's see where we are, because the last few days, all anybody can talk about in financial markets is a meltdown in the bond market. The way this works is yields, i.e., borrowing costs, go up, and that means that the price of the bond goes down. In the UK, the 30-year bond is at multi-year highs. In the US, that is also the case. And unlike the UK, where it is just a benchmark, in the US, this is where all the mortgages are. So it's a pretty big problem. In Japan, a country that hasn't seen inflation since I was in elementary school, and that's really a long time ago, the 30-year bond is at 4.1%. So borrowing costs have been going up sharply. Next slide, please. Now, as we said, the problem is more acute in the US and more or less in Italy. Those two countries pay 4 or close to 4% of their GDP in interest payments. Okay, this is a pretty big number. You'd need nominal growth of 5 or 6% just to be able to keep up with those payments. Okay, so it requires a lot of effort. Okay, and that means countries really can't have or they're not very equipped to deal with recessions. Next slide, please. Now, back to inflation. Let's see what sort of inflation we have. We have US goods inflation, we have European services inflation, including UK services inflation. The bar is where inflation currently is. The dot in the middle is the long-term average. As we can see, US goods inflation has jumped to over 6.4%. Producer price index in the producer price index just last week announced is up 6%. And that is up from 3% like a couple of months ago. Both UK services and European services also experience significantly higher inflation than usual. Okay, but it's really US goods that suffer from the twin headwinds of both the energy crisis and the trade war. Next slide, please. And this is overall headline inflation. I would argue in the US, UK, and EU. In the EU, it's 3%. In the UK, it's 3.3%. In the US, it's 3.8%. The St. Louis Fed has said that they would not be surprised to see headline inflation of 6% before the year is out. So, this is a massive this can be a massive shock. That is why the clock is ticking in Hormuz. Okay, the faster this goes away, the more likely the quicker inflation will likely return to its previous trajectory of going slowly back towards the 2%. If this thing lasts for a few more months, then the inflation outlook changes materially, which is bad for bonds. It could mean sharp rate hikes. It could mean worse economic conditions overall. Next slide, please. Now, what so far we have seen, and this is an ongoing debate Ben and I have, is this chart. Now, this chart tells us where the bond market sees inflation expectations. The 5-year and the 10-year US bond market are pricing in inflation at at 2.5 to 2.7%. Okay, and that is long-term inflation. So that makes sense. You know, if your target was 2%, pricing in a long-term inflation of 2.7 or 2.5 just on the back of what's happening this year is probably a sensible call. We still feel a little bit nervous about the 1-year market that's pricing in an inflation of 3.14%. So lower than where it is today, and more important, lower than the 6% the St. Louis Fed told us it might go to. That means that the bond market and the general debt market still has room to be surprised negatively, even at those yields. Okay, even at those borrowing costs. So if you're a business, this matters. Okay, because this means borrowing costs could go higher more. And if you're an investor, also that matters because that might have implications for short-term implications for bond holdings in a portfolio, especially longer-term bond holdings. Okay, because if there are surprise rate hikes, for example, it's really the longer end of the yield curve, the more long end bonds that could suffer more. Next slide, please. Speaking of interest rates, this is where the market is presently positioning itself. I think when we last spoke, it was rate cuts across the board, especially US and UK. The US was projecting 3 rate cuts just a few months ago. The UK was projecting 2 rate cuts, and the EU was supposed to be stable, or maybe, at the very worst, see 1 rate hike. Now, markets are positioning for a 1 rate hike in the US until the end of the year, 2 to 3 rate hikes in the UK, and 3 rate hikes in the EU. And given where we see the break-evens, high inflation expectations, these numbers could go higher. Okay, so if in the next month or so you see much more sturdy rate expectations than where we are today. Which brings us to the point. The US Federal Reserve, the world's de facto central bank, it's the world's biggest central bank, it's the world's most important central bank, has a new chair, Mr. Kevin Warsh, directly appointed by Mr. Trump. Next slide, please. Now, we have spent a lot of time debating Mr. Warsh, whether he would be likely to reduce interest rates just to please the president, even in the face of rising inflation, which could be a big mistake, especially for longer-term bonds, which would then begin to price in more inflation if they saw the Fed unwilling to fight it. Okay, now, just to be sure, there was another side of the argument which said, okay, will the markets test Mr. Warsh? We have quickly dismissed that one, at least in terms of history. Yes, Mr. Warsh might not be the most popular person around, simply because there is some skepticism about what sort of commitments he made before he was appointed. But markets don't generally react negatively to the appointment of a new Fed chair. The 32.8% drawdown when Mr. Greenspan was elected in 1987 was just the unfortunate coincidence of experiencing Black Monday 2 months after his inauguration. Beyond that, Mr. Bernanke, Ms. Yellen, Mr. Powell haven't really been tested by financial markets. So we don't fear that markets are going to attack the Fed. And it is our view that the Fed will act responsibly, raise rates if they need to, or lower rates when they see room to do so. So institutionally, we don't have much reason to worry yet. Okay, we understand things are a little bit unusual between the White House and the Fed, but still, we don't see major reasons to worry. So yes, we could see rate hikes in the US, and that could trigger rate hikes also in other places, especially Europe and also the UK. Next slide, please. As long as this persists, because there is the economic element of this, and some of you may own businesses, we see also global supply chain stress at all levels. So this is by the New York Fed. It is an index that calculates global supply chain stress. We have not seen this type of stress since the pandemic, really, and we've only seen it once before in the past almost 30 years, and that was the global financial crisis. Okay, so um, supply chains, as you would understand, are stretched thin. Next slide, please. Now, where is this more pronounced? The higher the number, the worse it is. It's more pronounced in Japan, China, and Taiwan. They depend on Hormuz for about 80% of their oil imports. Less so in the Eurozone, and surprisingly, for all the bad press the UK has been getting, supply chain stress in the UK is actually one of the lowest amongst developed markets. Okay, which could be good news for UK inflation going forward. Um, and in fact, that should not be too surprising. We saw UK inflation recede yesterday from 3.3% to 2.8%, more than what economists had predicted. So, for the time being, UK inflation seems contained. Okay, I mean, I don't think it's going to, that's necessarily the picture if the Strait of Hormuz remains closed for a couple of more months. Okay, it totally depends on this big geopolitical event. But for the time being, UK growth has exceeded expectations on the upside. UK inflation has exceeded expectations on the downside, so better than expected inflation. Um, and this is good news. The UK economy, especially given where the global economy is not in a particularly bad place. So please keep this in mind as we head on to the next section, led by our Chief Investment Officer, Ben Seeger-Scott.
Thank you very much, George. So, George talked there. There are various challenges out there, but what might surprise you, and obviously, if you receive our roughly monthly investment newsletter, you already know this. But despite some of those challenging backdrops, actually, the global economy is doing relatively okay, and increasingly, businesses are doing well. So, if we pivot now a little bit on the next slide, just by way of background, this shows global investment markets for the year so far. And yes, the commodities, the black line at the top. Oil has done obviously very well this year, but that's come from a very low level. But actually, most of the rest of the world in investment terms, particularly equities, continue to do pretty well. And I will briefly touch on the rebalances that we did. But what the two major changes we made back in January was to increase emerging market exposure and developed market exposure through the US. And a couple of things really to highlight on this chart. One is that the world is continuing to do pretty well. Businesses are generally thriving. There are some challenges building, but actually, one aspect of investment really is to embrace risk to generate a long-term return. So, in that sense, you are potentially rewarded for taking on these risks, accepting the long-term growth that comes with them. And it's been particularly helped because even though there are problems with a little bit of inflation, some challenges with oil, supply chain that George talked about, the debt and inflation dynamics, that comes on the back of a period of actually quite a benign economic environment with a lot of tailwinds. It's enabled businesses to continue to do pretty well despite that backdrop. And you see that here, the blue lines, the light blue line are emerging markets, the dark blue line is developed market equities. Through March, the first month of the conflict in Iran, you can see they did dip, but then they came back, and we saw this sort of 6-ish week spiral that's quite typical of geopolitical events. And actually, emerging markets are doing very well for the year so far, and we still have a positive outlook for them. Developed markets as well, comfortably ahead of what you might otherwise expect. Where the pain is being felt is in bond markets. And you can see there, government bonds now underwater for the year, corporate bonds, where you're relying on credit to corporations, also suffering. And that's where the pain is being felt. Equities that rely on long-term cash flows and ability of business to pay back, businesses are thriving, equity is being rewarded. It's where debt, where inflation, when credit worthiness comes under pressure, where interest rate expectations are rising. That manifests in the bond market, and that's where you're seeing a little bit of pain coming through. And diving a little further into developed markets, so that developed market line is all developed markets globally. On the next slide, I'll break it down as we normally do by regions, and what you can see. Most regions actually doing pretty well for the year so far. Let's differentiate them a little bit. Japan, that sort of light green line, I think what this really shows, many companies came into this year, many economies came into this year doing pretty well. And this really reflects what I was saying before. Up until the onset of the conflict, actually the economic outlook was looking better and better. So a lot of these countries fell initially, but off an already higher base. And that's true. You can see if Japan had a good start to the year, and obviously around that January bounce, we took some profit there. You can also see that light blue line, that's the UK. And the UK started off doing very well, but actually over the last few weeks, it has come under pressure. The UK economy has some particular headwinds. We have high unemployment. We're now looking at wage growth below expected inflation, so negative. So effectively, wages are likely to be falling in real terms. And there are some challenges at the UK domestic level, and you can see that over the last month that the UK has come under pressure. Europe in the dark blue line, again, participating in that good news. Europe is a little bit more exposed to events in the Middle East. Europe has a lot of very energy intensive industries. So even though it did recover through March and April, effectively it's moved sideways given some of the pressures there. And I think one of the very interesting ones on this chart is the US. And even though it looks like only the second best performer, you can see it sort of moved sideways through much of the start of the year. And then around the time that we rebalanced, which was late January, it was relatively flat. But actually, after suffering a little bit through the onset of the conflict, the US has really been benefiting for the last 6 to 8 weeks on the back of strong productivity gains and a robust domestic economy. The US economy is doing very well, and businesses there are generally thriving. So the US has done particularly well in the most recent period, but broadly markets are a lot higher than you would perhaps otherwise think. Over the next two slides, I'm just going to talk about there are some metrics here, but I think the two things we're often asked about, and probably the two most important fundamentals for looking at equities, which is what we'll dive into, is valuations and earnings growth. And there is a general view, quite rightly, that markets are expensive. But if we go on to the next slide, we'll see that isn't universally true. This is forward price to earnings ratio is a very common measure of valuation. It takes the current price and compares it to the earnings. As a shareholder, you're entitled to all the earnings of a company. Another way of looking at this is how many years does it take to pay that back? And you can see on the left-hand side, the price to earnings ratio, the current level is the blue bar. The white dot shows the post-global financial crisis average. So where the bar is above the dot, it is overvalued or expensive. If it's below, it is cheap. And I've calculated that on the right-hand side. It shows roughly how expensive or cheap different regions are. And look, yes, the US is looking pretty expensive. It's about 25% overvalued. The world index is dominated by the US. It drags up that valuation. But actually, other parts of the world are looking relatively cheap. The UK looks fairly cheap. Europe looks a little expensive. Japan quite expensive. But other areas like Asia, the Asia Pacific region and emerging markets are still below their long-term average. And that's even after that strong run that we saw in emerging markets. And valuation is just one way to look at these things. The flip side is that valuation justified? A stock can be cheap, but it can be fair to be cheap if the outlook for that business is struggling. Equally, a company that's expensive can be justified by strong earnings growth. Because one way that valuations come in, and this is what we've seen over the last couple of years, is earnings growth can catch up with valuations. This is typical for example, in the US, where we know that the mega cap tech names look very expensive. they are expensive, but their valuation has been coming down because they've had very strong earnings, and those have sort of continued into the most recent earnings period. So with that in mind, let's look at the next slide that shows earnings growth for each of these regions. So this is the same regions we saw before. Again, the white dot is the post-global financial crisis average. And in each case, the dark blue line is expected earnings growth over the next year. And then the light blue line is the year after that. So together, the next 2 years earnings growth compared to their average. And so, yes, look, equities are quite expensive, but earnings growth is 2 or sometimes even 3 times that long-term trend. And actually, if a market is 20% overvalued, but you have 10% above the average earnings growth this year and next, that is one way that those valuations can come back in quite a sustainable way. So I think we're certainly not complacent, and we do recognise that the markets look expensive. But these are the current earnings expectations. To an extent, they are validated. We're going through an earnings season at the moment, and earnings growth, particularly in the US, is about 20% higher this year than last year. Some of that is skewed by the mega cap tech names, but not all of them. And most companies are doing pretty well. If we move on to the next slide, looking at this at a slightly more through a portfolio lens, I will just touch on the changes that we've made and performance. So on the next slide, I think this is the changes that we've made. We do a rebalance every quarter. This is a good discipline just to take profit on some of our winners, top up some of our losers, just to get back to that neutral stance. We made some bigger changes in Q1. So in the change we made in April, we made no change to the core models. We made a small change in the sustainable models, switching out a dividend fund into something that is more of an equity growth index. The dividend funds tend to be a little bit more defensive, and we want to harness, particularly after a tough period, we wanted to harness some more normalized growth potential. But actually, the reason that we chose not to do anything, geopolitical events are not forecastable. And as you've seen, despite all of the negative news that we see on perhaps the TV or reading the BBC, actually markets are grinding higher. And with that in mind, the changes that we made in Q1 we think are still very valid. That was increasing emerging markets. As you've seen, they've done well, but the outlook continues to look positive. We also topped up the UK, but crucially, as you'll recall, hopefully from the last webinar and the rebalance note that we send out to you, we tilted away from mega cap tech. So we reduced our exposure to those big AI-driven names and put it into more of the rank and file companies that we think will benefit from the next period of growth. We put some into smaller companies, again, where valuations are much more permissive, and we put some into US utilities that we think will benefit from demand from AI, from data centers and computation. We did that by reducing some exposure to the higher risk fixed income, and as we talked about earlier, those areas have now come under pressure, reducing the UK and taking some profit on Japan as well. But hopefully you're receiving that monthly investment note. If you're not, please do get in contact and we'll make sure, as long as you're an investment client, because it's for clients in the existing service, we can make sure that is sent out to you. So if we go on to the next slide, I will summarize where we are and then just touch briefly on performance before we wrap up. This is based on our balance model, but effectively this shows all of the different areas that we look at. And over on the right-hand side, sorry for what is a busy chart, but this tells you where we are overweight, so we have more than typical exposure and less. And overall, we have elevated exposure, so we're overweight to equities. That's particularly in the US, tilting away from mega cap, underweight the UK, that is facing pressure. And you see across fixed income, we're underweight some of the riskier areas that we think are more exposed to credit issues and rising borrowing costs. In the UK government bonds, we are overweight, but specifically that's to inflation-linked or US inflation, Treasury inflation protected securities. So these are somewhat resistant to changes that are driven by inflation, which is where a lot of the changes are happening. So I'll wrap up on the next few slides. Let's just touch on performance. The next slide, you can see year to date, the blue bars show each of our model portfolios. As always, the almost black lines show the peer group. And I'm pleased to say, despite everything going on in the background, portfolios are doing pretty well. These for the first few months are pretty strong growth, probably higher than many people would think, given what is going on, and comfortably ahead of the peer group, which we're obviously pleased to see. And then on the next slide, on a 1 year basis, I think is a more normal time frame. You can see very strong returns compared to a year ago. And then finally, just to put that in the 5 year perspective, 5 year growth, as you can see across the board, strong growth continues for all of the portfolios and comfortably ahead of the peer group. So hopefully that is good news if you are an investor. If we move to the next slide, I will then wrap up. We go to concluding slide, please. To wrap it all together, there are inflationary pressures building. There are some debt levels that are uncomfortable but are manageable. Those borrowing costs have been pushed up. Supply chains are stressed, but they come from a period when that have been a little bit more permissive. Despite all of that, because of those strong business fundamentals that are coming through, markets are grinding higher, valuations are mixed, they're not universally expensive, and strong earnings growth is coming through, and the outlook is actually pretty positive. What I would say, wrapping it all together, is whilst there are challenges, we are not yet facing extremely high inflation. It would take a serious deterioration of events in the Middle East. I think we talked about some of the scenarios last time. It would take a real deterioration to get us to the sort of 2022 level of very high inflation. As it stands now, I think grit in the wheels is probably the key phrase. The outlook is tougher, but actually that can be positive for businesses, particularly those that can lean into their competitive advantages. And crucially, it is a manageable environment for businesses, which is why we continue to be positive on equities. And as we said, portfolio performance is positive on all of the timeframes we report on here and ahead of the peer group. So if we go to the next slide, I think we're now on to the Q&A. We've got 5 questions submitted and live and a few before. We do have, sorry, I should have mentioned the topical cheat sheet. These slides are available after the presentation. If we haven't touched on it today, it's not that we don't think about it. We only have a certain amount of time. Geopolitics and tariffs are there, a couple of lines on each. The next slide, we've got some points in there. If we're thinking about AI, the UK situation, oil price, all in there. And on the next slide, we talk about sort of crypto and gold. So with views on all of these, they're not picked up right now. There's some lines here. So if we go to the Q&A, I will start with some of the live questions. First one, I think, is for George. Assume you're there, George. This is from Peter. And Peter asks, will supply chain pressure in the rest of the world not affect the UK indirectly as we're heavily reliant on imports, or is this accounted for already? George?
So obviously part of it is accounted for, but you're right, Peter. These numbers are not in isolation. So when let's say America experiences, it happened actually during COVID. America had experienced a shortage in masks, if I remember. And what the American government decided to do is just confiscate a few airplanes full of masks and divert them to the US. Similarly, they could reduce oil exports or what have you. Okay, these are all parts of the plausible scenarios. So, it's big countries fighting for resources. Even if the UK is okay-ish today, competition for resources might mean that it will not be okay tomorrow. None of this operates in a vacuum. So you're absolutely right.
Thank you very much, George. And the next one for you as well might be one from David that we have to go back on, but you may know the answer, which it's about the global supply chain stress indicator. And David is interested how that indicator is calculated.
Yeah, so obviously I don't have it on top of my head, David, but we will get back to you. It's published by the New York Fed, so the methodology would be it would be available.
Perfect. Thank you. We'll come back specifically. I imagine it will be a combination of these indicators tend to have a range of metrics that go in, some of which will probably be survey based, but they have things like the cost of shipping, the cost of insurance, and other metrics. But we will, assuming we have your email address, we will come back to you on that. But it's a publicly produced data series. Another one from Peter that I will answer, which is around growth. Peter asks, how do we square weak growth figures with the sentiment that businesses are thriving, particularly UK, US, and Europe? I'll have first crack and then see if George wants to add anything. I think there are two bits to consider. Overall, global growth is looking a little bit weak. But global growth, so GDP growth is composed of many different aspects. There are import-export dynamics, there are government spending and activity, and then there are just business earnings overall. And long term, you expect a correlation between earnings growth and GDP, but in the short term, that tends to be very weak. And just as a sort of side note, even though the growth outlook is positive, there is a bit of a risk, particularly in the UK, that we experience a period of jobless growth. Because actually, a lot of businesses can boost earnings both through increasing the top line and sales, a lot of that we're seeing in the US, but also cutting costs, which is some more of what we're seeing in the UK. So there's growth, but it could be jobless growth. What I would flag as well, a point that's often misunderstood or forgotten is that GDP is a real figure. So when we talk about GDP of, say, 1 or 2%, that is after the effects of inflation. So actually, if inflation is running around about 3% and real GDP is 1 to 2, then actual GDP, nominal GDP, is 4 or 5%. So actually a little bit higher, and those are some of the returns that you see coming through. So, businesses overall are thriving. Governments, to an extent, are not putting in quite as much. So there's a little bit of a sort of public to private switch happening as well. And then the overall higher numbers that you see once you add inflation back account for why you can have more in the private sector without it while the overall growth figure doesn't necessarily show up. Anything to add to that, George?
No, I think you explained it perfect.
Perfect. Then I will come back to some of the questions we have here. George probably knows the answer to this. On slide 17, let me see which one 17 is. So 17 is price. In fact, sorry, I can answer some of this. 17 is the price to earnings ratio. And the question is on slide 17, what would the US look like without the Mag 7? And the reality is the Mag 7 are pushing up valuations and earnings growth. But actually, if you strip them out, if you just equally, I'll take a different way. We look at, and I think it was in our Q1 rebalance, the areas that we invested in. So we said, look, the US is expensive. It's about 25% overvalued. The two indices that we topped up in January, which was an equal weighted index and a small cap index. The equal weight index, this may or may not be answering your question. The equal weight index takes the S&P 500, which is all the 500 largest companies in the US, and rather than weighting them by their market cap, equally weights them. So 0.2% of every company goes in. And we made this point back when we made the investments, which is if you look at equal weighted and if you look at small cap that represent the rank and file of the US, then valuation is actually around about flat. I think it is 3 or 4% overvalued or 3 or 4% undervalued. I think small cap is slightly cheap versus history. Equal weight is a little bit higher. But actually, on a lot of measures, if you take out the Magnificent Seven, then the market doesn't look particularly expensive overall. Now, the flip side of that is those earnings growth figures that I highlighted with 26% growth this year and 30% next year. Those also come down quite a lot as well. Still above the long-term average, but more like sort of double the long-term average rather than 3 or 4 times as high. So, the US does not look, a lot of companies in the US do not look particularly expensive, but there are also ones that don't have the eye-watering earnings growth. So hopefully that answers. George, one for you. It's on bonds. I know you love talking about bonds. What's the outlook for UK corporate bonds?
Um, okay, so it's not the outlook that's the point. It's so-called credit spreads. Credit spread is the spread between the yield of the corporate bond and the yield of the corresponding government bond. And credit spreads are incredibly tight. So overall, their outlook is the same as the government outlook, especially given the how tight the spreads are, i.e., investors right now are not necessarily being compensated for taking on the extra risk of buying a corporate. Now, just for education's sake, why do corporates usually have a positive spread versus the government, i.e., they higher cost to borrow? Because governments can always print their own money. Corporations arguably cannot. So you always have the government risk plus whatever your company risk is. It is very small, which means that the outlook for corporates, at least versus govies, is not necessarily great. We would have to see larger credit spreads to say, okay, investors are being compensated for the risk, and therefore they might the securities might have a better trajectory going forward.
Good. Thank you very much, George. And then the final one submitted before we go to sort of some of the pre-submitted questions. Again, I'll start. And it's pertinent to the point around credit. Nick asks, there's been a lot of concern about private credit companies and the risk they pose. Could this cause a 2010 style financial crash? Now we've written quite a bit on private credit. It's a matter of public record, so you can Google it. But we've been warning of private credit for the last couple of years. It got a lot of attention. It's something we've been worried about. It's part of the reason, not the entire reason, but part of the reason when we said we've exited some of the riskier part of credit, just in case there is a little bit of bleed through into those risky areas, because private credit does have a lot of challenges. It is not all terrible. Don't think the whole market will collapse, but because it is opaque, it is illiquid, it has a lot of challenges. There are problems growing in that part of the market. We don't think, though, it is going to lead to a broader systemic risk like we saw in the global financial crisis for several reasons. Firstly, private credit is designed to be relatively contained. There is a little bit of feedback because these private credit companies have been borrowing from normal banks. And now we're seeing in the earnings, we saw HSBC had quite a lot of exposure. The JP Morgan, all of the big investment banks have been lending to some of these private credit companies, and they will come under a little bit of pressure, and you'll see it reported in the news. But crucially, this isn't a huge surprise. A lot of the central banks are looking very closely at the level of exposure. There are very few feedback loops that we can see causing a bigger crisis. Central banks are very aware of it. They know how to contain these kind of risks. So the contagion risk is very low. We saw it, a couple of years ago with Silicon Valley Bank, where some US banks got into trouble. Central banks are now much better able, particularly because they have foresight of this issue and have been looking at it. They are much better able to provide liquidity around. They still make sure whatever is causing the problem, they won't look to bail out those investors because that creates moral hazard. But they will allow, I think, some of these funds to fail in a controlled way, and their efforts will be on preventing contagion. They've done it with Silicon Valley Bank. They've had now a decade to learn how to do this. So I think there are problems in private credit. I think it will be a shakeout and a maturing of the market. It is not all terrible, but there are going to be problems. All of the mood music is that it is very well contained, and the magnitude is simply not big enough to cause a wider systemic problem. Anything to add to that, George?
It's a pretty small market. The assets under threat are possibly no more than 200-300 billion. Um, as you very well said, 300 billion is what the Fed spent in 2 days just to repair U.S. peripheral banks. What is the threat? The threat is not private debt itself. It is delay from the lenders of the last resort, central banks, to act in case they see contagion. This is the risk. So first you have the risk of contagion, which you don't know, might materialize or it might not. And then you run the actual risk of the central banks not intervening quick enough. Okay, none of these two are base case risks, either that the central bank will fail or that there will be contagion. And for the worst to come to pass, both of these scenarios combined would need to happen. So the combined probability of this as a bad scenario is sort of a tail risk, maybe a tail risk and a little plus.
Good. Thank you, George. Just on the question of valuations, I've dug out the presentation that we did. Hopefully you can see that. We've dug out the presentation we did back in January where we made that change within the US. And you can see here the valuations haven't really changed since the start of the year because of the dip and then the rally. But you can see the different segments. You can see growth at the top. You've got the type of market, the current value, the 10-year average. The right-hand column shows what's expensive and not expensive. And like I said, the growth market is actually the most expensive part of the market. The Magnificent Seven are not as expensive as you might otherwise think because they have strong earnings growth coming through. The broad market, so that's the S&P 500, the 27% overvalued. But that one above, the large cap equal weight, there you can see if you equally weight, so your average company in the S&P 500, it's only 5% expensive, and smaller companies there you can see looking a little undervalued on that basis. So thank you for those live questions. We have a few pre-submitted questions as well. George, I'll bounce the first two to you. In fact, I'll link these. One is from Jonathan, who asks, anywhere left to invest now that all assets have declined in value, except perhaps residential property, or keep most of it in cash for now? And Cameron says, what is the better investment option nowadays, gold, stock, or oil? So George.
So they all have their place in the portfolio. Usually you would see portfolios much more heavy in equities and bonds and much less in gold, but gold does have a place in the portfolio. Sorry, oil is actually not part of your usual asset allocation, at least not directly. You might see exposures, for example, in energy companies, which is a hybrid commodity slash equity risk. But direct oil exposure is very, very difficult because ETFs that buy oil, exchange traded funds, usually they play the futures curve. Okay. And that means, and this is monthly, so that means there is a cost every month, as they say, to roll the contracts. Over time, because we're talking about long-term investments, over time those costs accumulate and they can really reduce profits. So that's why professional allocators would not necessarily opt to buy oil. First of all, it's strategic asset class, so can't really predict the price. But even if you could, the ways to play it are not very they're not very efficient.
Thank you very much, George. A few of the questions that we were sent in advance ask about, there are some that more relate to financial planning type of structures. So I'll give you a couple of quick answers, but might refer you separately to a financial plan that can go into more detail. One is from Julian asking what our view is of the value of a purchased annuity as a diversified part of an investment retirement strategy based on yields seen in the last 5 years with outlook for the same over the next couple of years. Again, everything that I talk about today is obviously not personal advice. These are just general comments about the broad market, and we would always advocate you seek formal financial planning advice. What I would say, annuities are a complicated area, particularly as it interacts with the rest of your financial planning and investment strategy, considering your financial planning requirements, your taxation requirements, your risk profile, and your investment considerations. As George highlighted, annuities are generally tied to bond yields. Bond yields have moved higher, so the relative returns on those can make them more compelling than they were. But it is important, and I think diversification is usually a positive thing. But I think you do need it's a more complicated one that requires financial planning expertise to see how it will interact with a lot of your other plans. And on a similar, sorry, different theme, this is from Clive. This is asking about long-dated gilts with a low coupon, and are they a good investment for high-rate taxpayers funding outside NISA with the intention to hold to maturity? I have a number of gilts maturing over a phased basis. Again, this is not personal advice, and again, everyone should, I would say this, but it's true, everyone should get personal planning advice on this. This relates to a well-known strategy. The way taxation works on gilts, capital gain is effectively, it can be tax advantage and there may not be capital gain to pay on it, but the income is taxed. And what you can do, because a lot of bonds historically were issued with a very low coupon, as rates have gone up, to get the prevailing yield, some is from capital and some is from income. So if you can find a bond with a low coupon rate, a proportion, perhaps a significant proportion of that, can be accrued with a considerably lower effective rate of tax. It is a well-established strategy. Again, it does need to be, I would advocate it should be integrated as part of a wider financial planning consideration. The route you suggest can make sense for some investors, but you also need to think about what other things you may be looking to put into the different wrappers. The final thing to say on that, it's becoming a tougher strategy to deploy because it relies on bonds being issued with a very low coupon. Now, before interest rates started rising post-COVID, we had a near decade of interest rates being near zero, so there were a lot of very low coupon bonds. As time has gone on, bonds issued now come with a much higher coupon. And actually, the supply of those low coupon bonds is becoming less and less. So yes, you can still build these ladders, but as time goes on, this view that you can pick a month and there will be a low coupon bond there is no longer the case. At the moment, if you're looking for coupons less than 1%, now you only have one or two every year for the next few years. So it's becoming harder and harder to build those ladders just because time has moved on. But it is, it is a sort of, it's an established strategy that can be supported. Then there's one more in this area before I bounce back to George. One from Graham saying how to invest in a SIP that can also be generating an income. And I think there was, yeah, I mean, I think, again, not personal advice. Do speak to a planner to take account of your level of risk. I think when you're structuring portfolios, they can be structured to consider whether you need natural income or whether you can draw down on a portfolio. I think some of the questions that we've seen in here, there was one I was thinking of earlier, I can't necessarily find, saying, what do I do in the current environment? The reality is markets are always volatile and hard to predict. So I would advocate don't try and integrate a longer term financial planning strategy with tactical considerations. It should always be done on what is your risk profile on a long term basis and what can be factored in. And yes, portfolios can be tailored to produce more or less income as a natural income, but equally, if portfolios rise in capital value, depending on your structures, some can be harvested and paid back. It really does depend on your specific tax consideration. But yes, you can tailor bespoke portfolios to have higher or lower natural income components. Whether or not you need that is more of a separate question. George, I know this one is is tough, but the best you can do. This is from Phil. Says for the top five UK energy companies, what proportion of the company's revenue and profit is generated by the trading platform as opposed to raw materials, production and sales?
Okay, so I will not pretend that this was a pre-submitted question, so I will not pretend to know this by heart. We did a little bit of digging. The numbers, very rough, are around 20% for Shell, around 30% for BP. These are the numbers that we know for sure. And for National Grid, the number is zero. So the numbers vary, to be honest. And they're not very well published, so we're making inferences. Okay, as a big asterisk there to that particular answer. But as a whole, where they do have exposure, you should calculate maybe close to a third or a fourth.
So significant but not dominant, I'd say.
Yeah.
Thank you. I'll try and push through the next few because I've only got a few minutes left. One from Andrew who says he has ongoing concerns about US holdings. I just asked how we focus on the risk management, particularly around Trump and the risk of the top 10 AI stocks. Hopefully, we've covered that to a greater or lesser extent. As we say, we also think that AI is starting to overvalued, so we've taken some profit there. But actually, as we've talked about, the US economy is naturally very productive, and there are lots of checks and balances that mean actually the outlook for the US, even if things deteriorate in the rest of the world, the relatively insulated nature of the US means it would probably counterintuitively fare better than the rest of the world. And that's why we're shifting into those rank and file companies that have greater protection from some of the policy shifts that the White House is deploying. So we do watch it very closely, and that shift we made at the start of the year away from mega cap tech into those other areas is in response of that. And partly that's on valuation, because valuation is often considered a margin of safety to allow for some more undulation sort of through it. Here is the one I was thinking of. I'll wrap. I'll touch on it quickly, but one from David. With the comments from many august bodies suggesting the market's now looking overvalued, what action should be taken in the management of SIPs in drawdown? This reflects my previous point that try and avoid considering tactical positioning in what should be a structural consideration around SIPs in drawdown and other aspects. But like I said, markets are expensive, but a lot of that is justified. The market is a real-time representation of every investor's expectations for the future. So just as many will think the markets are overvalued and are selling it, there are buyers on the other side that think those valuations are justified and are buying it. You will always find people calling for the next crash. That's how a market is made.
Sorry, Ben, if I might add something here. It's very easy to call crashes because it attracts attention and clicks. Okay, and in fact, it's been sort of a game in the past decade to predict gloom and doom. Okay, but usually there are way more calls for crashes than there are actual crashes or recessions.
Thank you. I'll answer one more question live. Why is Asia Pac EM cheap on historic P if earnings growth is expected to be so strong? It's because, and you can see the slides afterwards. It's because they've come off from such a low base. So actually, you can have very high earnings growth because the EM has been unloved and left behind for a very long time, and so because they've come off a low base, they suffered over the last few years. They can then have a big bump, and that goes from if you'd have looked before, they'd have looked really cheap. They have been some of the cheapest markets for the last few years. That's what made them attractive going into this year. So even though it's very high, that's just taken that valuation from very cheap to now still quite cheap. They've really been unloved for such a long time. Now is a positive environment. And I think we do need to leave it there because we're out of time. Thank you very much for listening. Thank you for all the questions. If we haven't answered, and I know there's a couple pre-submitted, as long as we have your email address, we will get back to you in the next day or two. Otherwise, you know where to find us. Please do reach out to your normal Forvis Mazars contact, and I look forward to seeing you all on the next one. Thank you very much.